The biggest market rotation in over a decade is happening right now, and 99% of investors are completely missing it. While everyone's been chasing the Magnificent Seven and large cap dominance, small cap stocks are setting up for what could be the most explosive move of 2025. Beyond the noise, find your clarity. This is Smart Money Sense. I'm your host, and today we're diving deep into the small cap versus large cap rotation that's reshaping the entire market landscape. By the end of this video, you'll understand exactly why this rotation is happening, how to position yourself, and most importantly, the specific catalysts that could drive small caps to massive outperformance. But before we dive in, if you're serious about staying ahead of market rotations and building real wealth through smart investing, hit that subscribe button and ring the notification bell. Less than 3% of viewers are subscribed, but they're the ones getting the most value from these insights. Let's change that today. Let's start with the fundamental question. What exactly is a small cap versus large cap rotation? Think of it like a massive tide in the financial markets. For the past 8 years, money has been flowing consistently toward large cap stocks, companies with market capitalizations above $10 billion. These are your Apples, your Microsofts, your Nvidias. Small cap stocks with market caps between $300 million and $2 billion have been left behind. The Russell 2000 index, which tracks small caps, has underperformed the S&P 500 by over 150 percentage points over the past decade. That's not just underperformance, that's a complete exodus. But here's where it gets interesting. History shows us that these rotations are cyclical. When large caps become extremely overvalued and small caps become extremely undervalued, the pendulum swings. And right now, we're seeing valuation gaps that haven't existed since the dot-com bubble of 2001. The current combined market cap of just the 5 largest S&P 500 companies is 5 times greater than the entire Russell 2000 index. Think about that. 5 companies are worth more than 2,000 companies. This level of concentration is unsustainable and creates massive opportunity for smart investors who position themselves correctly. Now, if you're finding this analysis valuable, take 2 seconds to hit that like button. It helps the algorithm show this content to more investors who need to understand these market dynamics. Your engagement literally helps build this community of smart money thinkers. So what's driving this rotation in 2025? There are 4 major catalysts, and understanding these is crucial for your investment strategy. Catalyst number 1, interest rate environment. Small cap companies typically carry more debt relative to their size, and much of this debt is floating rate. When interest rates were rising aggressively through 2022 and 2023, it crushed small cap profitability. But now, with Fed rate cuts expected throughout 2025, small caps get a double benefit. Lower borrowing costs and improved valuations as investors seek higher returns in a lower rate environment. Catalyst number 2, economic resilience and domestic focus. Small cap companies generate about 80% of their revenue domestically, compared to only 60% for large caps. As the U.S. economy shows continued strength, while global growth remains uncertain, this domestic focus becomes a major advantage. Additionally, reshoring initiatives and supply chain reliability investments favor smaller U.S.-focused companies. Catalyst number 3, valuation compression. According to the Jefferies small versus large valuation model, small caps currently sit in the 5th percentile of relative valuations, levels last seen in 2001. The average price-to-book ratio for S&P 500 companies stands at 5.0, while Russell 2000 stocks trade at just 1.8. This represents the widest valuation gap in over 20 years. Catalyst number 4, earnings recovery momentum. After nearly 3 years of declining earnings, small caps are finally showing positive growth. First quarter 2025 data shows small cap earnings growing for the first time since 2021, while Wall Street analysts are raising estimates rather than cutting them. This fundamental improvement provides the foundation for sustained outperformance. Before we continue, I want to know what you think in the comments below. Are you currently positioned in small caps, or have you been focused on large cap growth? What's your biggest concern about making this rotation? Your insights help shape future content, so share your thoughts. Now let's talk strategy. How do you actually capitalize on this rotation? There are several approaches, each with different risk and return profiles. The broad market approach involves using ETFs like IWM, which tracks the Russell 2000, or VB, which focuses on small cap value. This gives you diversified exposure without the need to pick individual stocks. The advantage is simplicity and diversification. The disadvantage is that you're also buying the 40% of Russell 2000 companies that are currently unprofitable. The active selection approach involves identifying specific small cap companies with strong fundamentals. Look for companies with consistent profitability, strong balance sheets, and growing market share in defensive or growing industries. Key metrics to focus on include return on equity above 15%, debt-to-equity ratios below 50%, and consistent free cash flow generation. The sector rotation approach recognizes that certain sectors within small caps are better positioned than others. Historically, financials, industrials, and materials have led small cap rotations. Regional banks, in particular, benefit from rising net interest margins in a falling rate environment. Infrastructure and construction companies benefit from continued government spending on domestic projects. The timing strategy is perhaps most crucial. Small cap rotations tend to be momentum-driven once they begin. Early positioning is key, but so is risk management. Consider dollar-cost averaging into positions rather than making large one-time investments. This protects against the higher volatility that small caps naturally exhibit. But let's be realistic about the risks. Small cap investing isn't for everyone, and this rotation isn't guaranteed to happen or sustain itself. Risk number 1: economic sensitivity. Small caps are more sensitive to economic downturns. If the U.S. economy experiences a recession in 2025, small caps will likely underperform significantly. Their higher leverage and cyclical nature make them vulnerable to economic shocks. Risk number 2: liquidity challenges. Small cap stocks have lower trading volumes, which means larger price swings on relatively small volume changes. This can work in your favor during uptrends but can create significant losses during market stress. Risk number 3: company-specific risk. With less analyst coverage and often weaker governance structures, individual small-cap companies face higher business risk. This is why diversification is even more critical in small-cap investing than in large-cap investing. Risk number 4: false starts. We've seen small-cap rallies begin and then fail multiple times over the past 5 years. The summer of 2024 saw a significant small-cap rally that ultimately faded as large-cap tech resumed its dominance. There's no guarantee this time will be different. The key is position sizing and diversification. Small caps should represent a tactical allocation within a broader portfolio, not a bet-the-farm strategy. Quick question for you. What percentage of your portfolio is currently in small caps? Let me know in the comments. Most investors are significantly underweight small caps relative to their market representation, so you're probably not alone if your allocation is low. So how do you implement this strategy practically? Here's your action plan. Step 1. Assess your current allocation. Calculate what percentage of your equity portfolio is in small caps. Most target date funds and balanced portfolios have 5 to 10% small cap allocation, which may be appropriate for conservative investors. Step 2. Determine your risk tolerance and time horizon. Small cap rotations can take 12 to 18 months to fully play out. If you need the money in less than 2 years, this strategy may not be appropriate. Step 3. Choose your implementation method. For most investors, starting with broad-based small-cap ETFs makes sense. IWM for general Russell 2000 exposure, VBR for small-cap value focus, or VTWO for a more comprehensive small-cap approach. Step 4. Consider timing and sizing. Rather than investing a lump sum, consider investing over 3 to 6 months to smooth out volatility. Start with a smaller position and add if the rotation thesis plays out as expected. Step 5. Set clear exit criteria. Define what would make you reduce or eliminate small cap positions. This might include significant economic deterioration, Fed policy reversal, or technical breakdown below key support levels. Step 6. Monitor key indicators. Watch the Russell 2000 versus S&P 500. Relative performance, small cap earnings revisions, and Fed policy communications. These will give you early warning signs of whether the rotation is sustaining or failing. The small cap versus large cap rotation story is far from over. While large caps have dominated for nearly a decade, the setup for small cap outperformance in 2025 is compelling. From extreme valuation gaps to improving fundamentals to supportive macro conditions, the pieces are aligning. But remember, successful investing isn't about predicting the future with certainty. It's about positioning yourself to benefit when opportunities arise while managing downside risk. The small cap rotation represents one of the most significant opportunities in years, but only for investors who approach it thoughtfully and strategically. You've just gotten one step smarter. To keep building your financial sense, watch this video next and subscribe so you never miss an insight. This is Smart Money Sense. Keep building your sense.